Welcome back to this half hour of Transport Topics Radio here on SiriusXM Channel 146. Good afternoon. This is Dan Ronan. We welcome a new voice to the program, Steve Tam. He is the Vice President at ACT Research, and that is a Columbus, Indiana-based operation. Steve, first off, for our listeners, why don't you tell them they see the name of the company and they read your research here in Transport Topics and other publications. But go ahead and tell us exactly what ACT Research does and what your role is.
Hi, Dan. Thank you for having me on the show. So ACT Research was founded about 33 years ago, and our primary purpose in life is helping folks who participate in the commercial vehicle industry understand what's going on in the industry. One of our primary products is forecasting demand for equipment, so production and sales of new trucks and trailers, typically Class 4 through Class 8 trucks. My role here, I'm somewhat of a generalist. I've been with the company since 2000, and so I'm one of two primary analysts who do the heavy lifting on that forecasting work.
So as one who does forecasting and looks at the crystal ball of the economy, how would you say the economy is doing with regards to the trucking industry right now?
Well, we did really well in 2018, and actually the first quarter of this year hasn't been bad. But the problem with strong years like we had last year is that we can't continue to grow at that level. And so while freight is still growing, it's growing at a slower rate. And there appears to be an impending slowdown that will probably hit sometime kind of second quarter or maybe the beginning of the second half of this year. And then ultimately leads, I think, next year to perhaps what we refer to as a sectoral or rolling recession. So the transportation industry in and of itself might be in recession. The broader economy should stay positive in the 2020 timeframe, at least based on the way things are right now. But our industry might see some slowing in 2020.
With so much emphasis on freight and on the economy doing strong, and especially with the advent of e-commerce and next day delivery, how could one sector of the economy, the transportation side of the house, be struggling, but yet the overall economy might be growing between 2 and 3% with regards to GDP?
A large portion of the economy is actually dependent on services, which don't generate freight. And so that's a challenge for the trucking industry. And so it's those portions of the economy like manufacturing, for example, that are experiencing some challenges and some uncertainty as a result of the trade and tariff environment that we're in right now that may ultimately lead to that slowing in this portion of the economy. And the other piece on that is just stepping back and looking from a global perspective. We've had very solid global growth over the last couple of years, and that tends to be a cyclical phenomenon. And so after a period of strong investment, you'll experience a period where they pull back a little bit, and that's where we're going to see the slowing translate into softer freight in the 2020 timeframe, and even perhaps late in 2019.
Would you describe the economy for the last 8 or 9 years has been climbing steadily up a hill and making progress almost quarter after quarter with regards to GDP and unemployment and all of the other economic indicators that you look at? And then we've hit the peak, and now we're coming down the hill, and the question becomes, is the ride down the hill really steep and really scary, or is the ride down the hill sort of slow and gradual, and you say to yourself, okay, that wasn't so bad?
Your observation is right on. In fact, if we can get the numbers right in June, the U.S. economy will have experienced the longest expansion period with respect to GDP that it's ever experienced in the history of the country. And so that's a good thing. It's been a very measured, very methodical, very sustainable recovery since the Great Recession. Looking ahead, it is not a situation where we're going to have a precipitous crash, but rather an orderly slowing. The economy has gotten to the point where it just needs to step back and take a rest and get a little bit of perspective before I think it resumes growth. just at a high level, productivity and population growth are the two biggest drivers of economic expansion, and so you can only squeeze so much blood out of that turnip, right? We can only be so productive as workers in this big machine until we come up with the next clever thing to help us work even better. And it's up to you and I as consumers to handle the population growth and the consumption portion of that. So I'm always a cheerleader for the economy, telling people to go out and spend, 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 especially if it's going to drive freight.
With regards to freight and rates, where are we at with regards to rates, both the contract rates and the spot market boards? Where are we at right now?
So we look at a couple of different sources for that data. And in the spot market, I think there's consensus that those rates peaked in Q3 of last year. And if you look at the activity that we've seen in Q1, they're actually down about 10% Q1 this year compared to Q1 last year. We actually, since we're on the last day or near the last day of May, as we're recording this interview, we won't know what happened in the Q2 data finally for a couple of weeks, but all indications is that there's further slowing of rates in the spot market. The contract market lags a little bit, so it peaked probably Q3 of last year, and at least so far in Q1 and Q2, it has managed to stay positive. But the spot rates are a great indicator of where contract rates are ultimately headed. And so we do expect to see contract pricing go negative in the second half of this year. It'll be a fairly moderate dip into the negative side, but nonetheless, it will be lower on a year-over-year basis.
When times are good, people always buy. You need a new car and things are good and there's a little extra money in your paycheck, you buy a new car. I'm sure that in my coverage of the trucking industry, as I've gotten into it, it's the same thing. When you're feeling good about things, you go out and buy and you look at that new truck or that new equipment or whatever it is the exuberance that we had in 2018 going to result in 2019 and 2020 being that there's overcapacity in the market and that we may have too many trucks and we may have too many pieces of equipment out there, and that you have too many pieces of equipment and too many trucks chasing too few many jobs.
The way I always phrase that is too many trucks chasing too little freight, and that is exactly the situation that we are in right now. We track profitability among the publicly traded truckload carriers as an example, and in the fourth quarter of last year, they had an unprecedented 7% net profit margin. In Q1, that's already dropped down to 5%, but it's very clear, just like the consumers that you mentioned. Truckers, when they make money, the last thing they want to do is pay taxes on those profits. And so they'll go out and reinvest in their own businesses. And typically that reinvestment takes the form of purchasing trucks. Some of that activity is for replacement of older trucks that aren't able to do the work that they're normally called upon to do. But some of it, especially in times of strong demand and tight capacity, is to expand the fleet size so that they can, snip off a little bit more of that profit pie and put it in their pocket. And so by our estimation, in 2018, we probably added about 100,000 trucks to the fleet. As a percentage, it's a pretty small number, but it's 100,000 more than we had in 2017. And we'll do the same this year. We'll probably add another 50,000 or maybe 75,000 in 2019. And we're doing that even in the context of the environment that we just discussed, right? That slowing freight environment. And so we're going to end up where we've got too many trucks chasing too little freight. That ultimately puts downward pressure on freight rates. We're seeing that happen already. Downward pressure then on carrier profits. And when carriers are not making money, they typically pull back on investment. And so we expect to see reductions in truck production and sales as we move into the 2020 timeframe.
And we actually have seen this year, in a couple of cases, we've seen a couple of companies, big companies, decide to close up their business and to either liquidate or declare bankruptcy, which in my limited time in the trucking industry, I've not seen that before, where companies have just said, well, it's just there may be other factors in play here, but it struck several of us here at Transport Topics and reporting it as unusual, especially when the economy was going so well.
It certainly was a wake-up call to get those announcements, but I think you're right. I think in those particular situations, there may be something, other contributing factors besides the economy itself. But it's certainly something that bears watching. And again, we think it's going to be a fairly moderate correction moving into 2020. So we don't expect a lot of activity like that, but there probably will be some fleets who are going to be challenged to continue operations in an environment like that.
Our guest is Steve Tam. He's the vice president at ACT Research in Columbus, Indiana. He's on the Newsmaker line with us from Indiana, and this is Transport Topics Radio on SiriusXM. Back with more of our conversation with Steve right after these messages. Channel 146.